debt to GDP can't go up forever. And to me, we have a reckoning, but I don't know how to time when that's going to take place. I will say that because the reserve currency, we've been permitted to engage in behavior that, say, the Brits couldn't have behaved in. There's a new term I have, getting Liz Truss. We haven't been Liz Truss because we are the reserve currency, even though if you look at everything we're doing, it's much more radical than the Brits were doing.
Yeah.
What's that old saying? How do you go bankrupt slowly and then suddenly? Running deficits with full employment, basically at 7% of GDP, is a recipe that can't last forever. One of the reasons we haven't paid for it is in COVID, the entire private sector, 80% of individuals refinance their mortgages, so the average mortgage rate is still under 4%, even though at the margin it got to 8%. Corporations termed out their debt. That stuff rolls over in 25 and 26. If we're going to have a problem, it's probably more like late 25, early 26, but you just don't know. So,
and what is it that can create this kind of trust moment where people suddenly change their mind in terms of the price they want to have to lend money to the US?
It could be a failed auction. It could be if the Fed is wrong about inflation and it turns back up again because they're easing financial conditions into a melt-up. If they were to have to start increasing interest rates again, which is why I think they should be so cautious about their optionality, now that they've forward guided to a series of cuts, that could cause it. My best guess would be a failed auction, but honestly, it could be 6 months, it could be 6 years. I just don't know.
So if rates start to go up, how high can they go?
Well, that's a great question because right now, the 10-year, I guess it's around 4.5. It can go to nominal GDP. So let's say inflation went to 4.5, and real growth was 2.5 or 3. 10-year could go to 6 or 7. I'm not predicting that, but that would be consistent. If inflation did turn back up again and the economy wasn't weakening, I think you could get there. It's interesting. That's what happened in the 70s. The bond market didn't really respond until we went back up from like 3 to 12, and then it responded in spades. Again, I'm not predicting this, but as a practitioner, I'm very open-minded to it, and it's like on my radar.
Well, you say you make the most money from Fed mistakes. So yeah. Is this the way you are positioned now?
I'm short bonds. I'm not like mega short. I actually had good timing for once. I shorted them literally the day the Fed cut. And it's been kind of an easy ride. Since then, I should have been much bigger. Now that they've moved so much, I'm a little worried about, if anything, being too big. But yeah, no, that's the way I'm positioned. If I thought what we are talking about was happening and I don't see a sign of it yet, I'm just open-minded to it, I would be much bigger. I'm like 25% NAV short 10-year equivalent.